All right, so we are going to do a quick revision. Okay, so that at least as we are going on, then we're revising what we've learned already. So last week we learned about impairment, IAS 36 impairment, and we said that impairment occurs when the carrying amount of an asset is more than the recoverable amount. Okay, so when we have an asset whose carrying amount is more than the recoverable amount, then we have impairment. And so to determine impairment, we need to know the carrying amount of the asset, and we also need to know the recoverable amount. Yeah, so these are the two things we need to be able to determine impairment. And we said that the recoverable amount, okay, remember we said the recoverable amount, um, the recoverable amount comes from two items. Okay, one is the fair value, less cost to sell, and then the second one is the value in use. Okay, so these are the recoverable amount, but we pick the higher. So once you get this and you get this, then you choose the higher, which will become our recoverable amount. Okay, so that's what we learned last week. Then we also learned about cash generating units. Okay, and we said cash generating units refers to group of assets that generate independent cash flows. So if you have a group of assets working together to generate cash flows, they are called cash generating units. Okay, and we said that if an asset belongs to a cash generating unit and it is impaired, okay, then it means we have to carry out impairment tests on all the assets in the cash generating unit. So if we have a cash generating unit where we have, let's say we have goodwill, we have vehicle, we have equipment. Okay, these assets belong to a class. Okay, belong to cash generating units. Okay. If one of them is impaired, maybe the vehicle is involved in an accident. Okay, if one of them is impaired, it means we have to carry impairment tests. We have to carry out impairment tests on all the items in cash generating units. It's not only the vehicle that we should carry out the impairment test, but it should affect all the assets in the cash generating unit. Okay, so that is what we did. And then we also looked at allocation of impairment loss over cash generating units. Okay, so if an asset in a cash generating unit is impaired and we have an impairment loss, how do we allocate the losses over the assets in the cash generating unit? So we said,
Hello, Max.
hi.
Michael, please, can you unmute because I'm getting some feedback. Yeah.
Okay, okay, right. Yeah, so if we have a cash generating unit and then there's an indication of impairment, okay, and then we need to allocate the impairment over the cash generating unit. How do we start? Where do we start from? So we first of all start with the goodwill. If there's any goodwill in the cash generating unit, we allocate the impairment loss to the goodwill. If after the allocation to the goodwill, there's still a balance of the impairment loss, then we'll allocate it to the asset that is damaged. If there's any asset that is damaged in the cash generating unit, we'll allocate the impairment loss to that asset. If after that there's still balance of the impairment loss, then the balance will be shared among the rest of the assets, okay, on pro rata basis. So pro rata basis means according proportionally, okay, according to their proportion. Yeah, so that is how we allocate impairment loss. All right, so that's what we did last week. So today we are going to look at another standard. We are going to look at IFRS 5. Okay, we are going to look at IFRS 5, which talks about non-current assets held for sale, okay, and discontinued operations. Okay, so let's say that we have a machine here. We have this heavy duty machine. Okay, this is an asset. Okay, and we have been using this asset for maybe for some time now, but we have the management have taken a decision to sell the assets. Okay, maybe probably this asset is not performing so well, or they want to sell it to buy a new one. Okay, so now this standard talks about the process of um, recognizing this sale. Okay, how we are going to recognize the sale of this asset. Okay, so ideally, what will happen is, first of all, this issue will go to the board. This issue will probably start from management. The management will talk about it that, oh, we need to sell this asset, and then it will go to the board. Then the board will also review it, and if they are okay with it, then they will say, okay, let's sell the machine. Okay, now if they decide to sell the machine, the next issue is, how much are we going to sell it for? What is the asking price? Then where are we going to get the buyers? Okay, we also need to probably do some adverts, okay, in the newspapers, or maybe on radio or TV, that we want to sell our assets. Then another thing we'll consider is, okay, when do we expect to sell the assets? Maybe in the next month, in the next 2 months, in the next 3 months. Okay, so we consider all these things. Okay, who can tell us what else we'll consider? Let's say we want to sell this asset. I mean, what do you think we'll consider? Apart from what I've said, is there anything management or the board will look at? Any contribution? Oh, I've said everything. Okay, that's fine. So yeah, so we'll look at the market, the price, the buyer, and the advert, and all that. Okay, and then sometimes, what's the name? Probably we also pass a board resolution that the board have agreed that the asset should be sold. So there will be a board resolution to the sale of this asset. Yes. Okay. So this standard talks about, I mean, provide guidelines on how to treat an asset that management have decided to sell it. Okay. So assuming that management have decided to sell this asset, okay, we have this. Hello, any question?
Yeah, I was about to say that maybe they will engage people to come and value the asset and see how much the asset will cost as well.
Yeah, very true. So maybe they will bring in a valuer to come and, yes. I mean, when it comes to like huge asset like this, sometimes we need a valuer to come and professional to come and also, yeah, that's a good point. Mhm. So now, after agreeing on all these things, getting the market, I mean, getting doing the adverts, um, setting the price, let's say board approval, um, then setting the timeline to sell it. Okay. Now the next, so this has to do with let's say preparation towards the sale. Okay. Now when it comes to our accounting records, okay. So right now this asset is in our when we go to our balance sheet, okay, it is showing it will be showing as a non-current asset. Okay. We will see it in our balance sheet as let's say track, and let's say the value is 2 million. Okay, it will be showing here. But right now the issue is that non-current, when we say something is non-current, it means we expect to use this for more than a year. Okay, we expect it to use this for more than a year. But this track, we right now we have already decided the fate of this track. We want to sell it. So is it right to keep it here? What do you think? Should we still maintain it here under non-current assets, or we have to find somewhere and put it? What are your views on that? Should we still maintain it as non-current assets? We have not sold it yet. We are looking for a buyer, and once we get a buyer, we'll sell it. So should it be still be under non-current assets, or we should put it somewhere?
But in looking for the buyer, are we still using the asset?
Okay, so now we are not using it. We have packed it. Okay,
It's dormant.
yeah, we put for sale on it. It's dormant. We are not using it. So where do you think we can put it? We can record it. Okay, so obviously we can't record it under non-current asset because we anytime any moment from now, once we get a buyer, we'll sell it. So but all assets under this class or under non-current assets are expected to be used for more than a year. So this will move towards current asset. This track will move down towards current assets because it's under current asset that we expect to derive their benefit within a year. So, for instance, inventory, we will expect to maybe derive the benefits within a year or use it within a year. So this track will move from non-current assets and it will come to current current asset, or it come under current asset as assets held for sale. Okay, held for sale. Because any moment from now, once we get a buyer, we are going to liquidate this assets, and then that is it. Okay, so the first point you need to know when it comes to non-current assets held for sale is that we move it from non-current assets to current assets. Okay, we move it from non-current assets to current assets. So that's one important point to note under non-current assets held for sale. Yes, and Another thing is that, like like um like Mr. Boateng might ask whether the company will still be using it or not, as they are looking for a buyer. Okay, it is also an important question. So if you intend to sell an asset and you are not certain. I mean, you are still using it. Okay, things are not really in place. Then it means you can't recognize it under. You cannot recognize it as held for sale. Do you get it? So one of the conditions to recognize before you can recognize an asset as held for sale is that the assets should be available for immediate sale. Immediate sale. So if a buyer comes right now, you should be able to sell the asset to the buyer. But if you are using the assets and I mean once a buyer comes, probably you have to go through some process and all that. Then you cannot recognize it as held for sale. Okay, so let's look at um, conditions that must be met before before we can recognize an asset for held for sale. Okay, so one is that management is committed to a plan to sell the assets. Okay, management have a plan to sell the assets, and an active program has been initiated to locate a buyer. And so they have sat down, planned the sale of the assets, and they are already looking for a buyer. Then the other point is that the asset is being actively marketed at a sale price that is reasonable. Okay, so you cannot put any price on the asset. The price, the sale price should be reasonable. Okay, reasonable. And then see, the asset is expected to be sold within a year. We expect to sell the assets within a year. And then D talks about the fact that management are not going to change their their mind concerning the sale of the asset. It's not like management will. It's like management have taken a firm decision to sell the assets, but if management are not really sure whether they should sell it or not, then they cannot recognize it as held for sale. Okay, so these conditions must be met before you can recognize an asset as held for sale. Okay, all these principles are there to make sure that the I mean the presentation of the financial statement or the items in the financial statement are reported fairly or to reflect the actual situation on the ground. So, for instance, you have recorded an asset as held for sale. Meanwhile, you are not looking for a buyer. Meanwhile, you don't have any plan to sell the asset. Meanwhile, you don't even know when you sell the asset, and yet you have recorded the asset as held for sale. Okay, in that case, it doesn't give a true reflection of the the what's the name, the status of that asset. Okay, so these guidelines are there to at least ensure proper financial reporting. All right. Okay, let's continue. Okay, whatever we discuss here, okay, also applies to disposal groups. Okay, disposal group is a group of assets that we have decided to sell, and that's why it's called disposal group. So it can be a branch. Maybe you want to sell all the assets in a particular branch of your company. So that branch becomes a disposal group. So you want to sell all the assets in that branch and close down that branch. Okay. So let's look at an example. Okay, and this example is to test our understanding on whether an asset can be recognized as held for sale or not. Okay, so let me read. Company A is committed to a plan to sell its headquarters building. Okay, so this company wants to sell their headquarters building and has initiated an active program to find a buyer and complete the plan. Okay, the building is being marketed at a reasonable price and completed sale is expected within 12 months. Okay, it is unlikely that this plan will change significantly. The company will not actually vacate the building until a buyer is found, but then the time taken to vacate the building will not exceed what is regarded as usual or customary for such building. Okay, so now the question we have to ask ourselves is, can we classify this headquarters as held for sale based on, the information we have? Are they ready to sell it? Have they satisfied the conditions? Okay, so when we go through it, one, they have a plan. So one condition is met. So and they have an active program to locate a buyer. So another condition is met. They also have a reasonable price for the building, and they want to sell the asset within 12 months. So all the conditions are satisfied. So we can say that they have met all the conditions. Okay, so we can say that, but the only issue is that they are still using the building, but then when a buyer comes, they will vacate the building. Okay, and it went on to say that the period for them to relocate or move out of the building is not, it's not something material, or it's not going to take so long. Okay, so at the end of the day, we can conclude that this headquarters building can be classified as held for sale. Okay, so that is it. Okay, now let's look at another scenario. Company B is also committed to a plan to sell its headquarters building and is precisely in the same situation as Company A, except that it will not vacate the building and transfer it to a buyer until a new headquarters building has been constructed. So we have another Company B, and as for them, they have also decided to sell their headquarters building. But the only difference is that they are not going to vacate the building until they build a new headquarters building. So can they classify their building as held for sale or not? Looking at the criteria we have discussed. Can Company B say they can classify the asset as held for sale? Okay, in this case, no, because this asset is not ready for immediate sale. If a buyer comes right now, they cannot move because they are saying that they need to build a new headquarters building before they will move out. So it means they are not ready to sell it. Okay. All right. Is there any question so far? Okay. Okay. So let's continue. So let's say that now we have agreed to sell this asset. All right. And now when it comes to financial reports, we deal with figures. Okay. So what figure should we use to represent this asset? Okay. How should we recognize, or what value should we place on this asset in our financial statement? So that's what we are coming to look at. Okay, so that's measurement of non-current assets held for sale. Okay, so when we have decided to sell an asset, what should be the value? How do we determine the value of assets held for sale? Okay, so there are two things we need to look out for here. So every asset has a carrying amount. Okay, right? The carrying amount is the let's say the book value. Okay, so every asset has a carrying amount. So we have our track, we want to sell it. Okay, and let's say that the carrying amount is 2 million. Okay, now the fair value less cost to sell. Fair value less cost to sell is maybe 1,500,000. Okay, all right. So the current amount is the book value. Okay, the value that it appears in the book of the company. The fair value is, or less cost to sell is the market price. Okay, is the market price minus any cost we incur in selling it. Okay, cost to sell has to do with cost of selling the assets, which can be advertisements. Okay, they are cost to sell. So we have two values here, carrying amount and fair value less cost to sell. Now, which one should we pick as the new carrying amount of the asset? Are we going to use the carrying amount, or we are going to use the fair value less cost to sell? Okay, any idea? Which one do you think we will use?
The fair value less cost to sell.
Okay, very good. Yeah, so we in this case we are going to use the fair value less cost to sell. Okay, so what is the reason for selecting the fair value less cost to sell? Any reason?
You see, the financial statement should present a true and fair, affairs of, what we are stating or the value of assets we are putting, in the account.
Okay,
So um, that's why I think the fair value less cost to sell should feature. Yeah.
okay, yeah, that's correct. Yes. So yeah, because this gives us like the at least the accurate value, not if not accurate, at least the let's say the reasonable value of the assets. Okay, so we will pick this. Okay, now assuming that um we'll pick the fair value less cost to sell in this case. Okay, assuming that the carrying amount the carrying amount um is 2 million, like the other one. Okay, and then the fair value less cost to sell is 3 million. Okay, so in this case, which one are we going to pick? Are we going to pick the fair value or the carrying amount?
I'm still the fair value.
Okay, all right. Okay, that's fine. Okay, that's good. Yeah. So there's a principle we are going to look at. Yes, the first what you said here, the first one is fine. Okay, the fair value is fine, but the second scenario, we'll explain it further. All right. So let's start with this. So here you can see that the carrying amount is more than the fair value. Okay, so it means there's an impairment. Remember we said impairment is when the carrying amount is more than the recoverable amount. So here you can see there's an impairment. So in order to write off the impairment, we have to pick the lower. Okay, we have to pick the fair value. We have to write down this 2 million to 1.5. Okay, so that is why we selected this. Okay, now when we come here, the current amount is 2 million, the fair value is 3 million. It means there's no impairment here. There's no impairment. Okay, because the fair value is even more than the current amount. And what it means is that if you sell the assets, okay, you are going to make a profit of 1 million, because profits on disposal, okay, is the selling price, okay, minus the current amount. Okay, the profit is equal to selling price minus cost price. So this is like the selling price, this one is the cost. So we even make profit here of 1 million. Okay. So it means in this case the asset is not impaired. So we will maintain the carrying amount. Okay, we will maintain the carrying amount of the assets in our books. Okay, in our books. Because even if we sell it, we even get profit. We get it. So the danger is that we don't want to report we don't want to report, let's say, the assets carrying amount of 3 million, and at the end of the day when we sell it we get 2 million. So that is the danger, that is the issue the standard seeks to address, that we are reporting something high, meanwhile um, when we sell it or dispose it we are getting something less. But if we report something less and when we sell we'll get something high, in that case, it is acceptable. Okay, so the standard says that when you are determining the current amount of assets held for sale, okay, you have to pick the lower of the current amount, okay, um and then the fair value,
Really less cost.
yes, less cost to sell. So all the time you have to pick the lower. So if so in the first example, you can see that the fair value is lower. And so that's why we picked it. Okay. In the second case, we realize that the current amount is lower. So that is why we picked it. So that's how we go about it. Okay. That's how we go about it. But another issue is if let me okay, if you have a situation like this, okay, where the current amount is more than the fair value less cost to sell, okay, after picking the lower figure, which is the fair value less cost to sell, you also have to recognize impairments. Okay, like I said, this asset has been impaired because the current amount is more than the fair value. Okay, so determining after determining the value of the non-current asset held for sale, you still have to also calculate for impairment loss. Okay, but in this case, in our second example, we don't need to calculate any impairment loss because the fair value is even more than the current amount. Okay, so the conclusion is that if you are determining the value of non-current assets held for sale, we have to determine the current amount. Okay, so in examination, usually you'll be asked to calculate the current amount, but the fair value less cost to sell, they usually give that value. Okay, so your work is to determine the current amount. Okay, so the fair value less cost to sell. So we need to determine these two figures. After that, we'll pick the lower. Okay, we pick the lower. But if the current amount is more than the fair value, we have to go ahead and also determine impairments. You see, you have to go ahead and determine impairment loss on the assets. Alright, so that is how the standard is. Alright, so let's continue. Okay, another thing we have to note is that non-current assets held for sale are not depreciated. Okay, and the reason is because we are not using it. It's like we have the asset, we have parked it somewhere, we are looking for a buyer, so we don't depreciate it. Okay, but when it comes to other expenses, probably as we have packed it, probably we do some cleaning. Yeah, though it may be dusty, so probably we may be cleaning it, we may be servicing it and all that. So those expenses that will incur as we wait for a buyer, those expenses will be recognized as an expense. Okay, those ones, but we don't depreciate the assets because we are not using the assets. Okay, so let's look at a disposal group. Okay, a disposal group is a group of assets that we want to sell. Okay, we want to dispose of. So whichever means we want to dispose of, yeah, it's up to the company. The company can decide to sell it or maybe throw them away. Okay, so a group of assets that is to be disposed either by sale or otherwise. Okay, together as a group in a single transaction. It's called disposal group. Yeah. It's like a group of assets that we have bundled together to sell or to dispose of. All right. Okay, now let's look at an example. On 1st July 2017, Do It All Limited, which prepares financial statement to 31st December, classifies a non-current asset as held for sale. Okay. The asset's carrying amount on that day is 10,000 cedis, and its fair value less cost to sell is 9,500. The asset is sold in May 2018 for 9,400. Okay, so required. Calculate any impairment losses or gains that should be recognized if the asset's fair value less cost to sell at 31st December 2017 is 9,200, 9,200, 9,700, 10,100. In each case, also calculate the gain or loss that should be recognized on the disposal of the asset. Okay, so we have a company that wants to sell their assets, okay, and on the dates of decision to sell the assets, the carrying amount of the asset was 10,000 and the fair value was 9,500. Okay, so let's see how we go about it. Okay, so that was on 1st July 2017. So that is when they decided to sell the asset. The carrying amount was 10,000. The fair value less cost to sell was 9,500. Okay, so the first thing we need to do is we need to find the initial measurements. Okay, the initial value of the non-current assets held for sale. Okay, so which value are we going to use? Are we going to use 10,000 or 9,500? What do you think?
9,500.
Okay, very good. So on 1st July 2017, okay, we are going to the current amount of this asset, the non-current asset held for sale, is going to be 9,500. All right. Now the company sold the asset the following year. Sometimes you may make all the plans and everything, but it takes a while for the asset to be sold. So as at 31st December 2017, the assets had still not been sold. Okay, so but it is the end of the year, so we need to report on the assets, even though we've not sold it, but we need to report on the assets. So the question is, what value should we use? Are we going to maintain this same 9,500, or what are we going to do? So what happens is that, fine, once we classify the asset as held for sale, we don't depreciate it again. Okay, but then we check the fair value. Okay, we check the fair value uh, along the line. Okay, we check the fair value until we sell it. Okay, so even though this is 9,500, it the value will not be the same as at 31st December. Okay, because probably market condition might change. Do you get it? Things even these days, looking at how inflation is and how prices keep increasing. Okay, we it's likely by the end of the year the price would have changed. Yeah, so it means we need to find the updated fair value as at 31st December. We need to always update the fair value of the non-current asset. Okay, so in our balance sheet, okay, as 31st December, our balance sheet under our current assets, okay, under our current assets, that is where we record the non-current assets held for sale. So we need to know the fair value as at this date. Okay, so the question said that um, the question said, okay, even yeah, I think I missed one thing. Okay, so here on 1st July 2017, okay, after determining the carrying amount, which is 9,500, we have to determine impairments, because you can see that the carrying amount is more than the fair value. So we have to record impairment loss of 500. See, there's an impairment loss of 500. So this will go into our income statement as an expense. Okay, so let's continue. At 31st December, we have still not sold the assets. Okay, but we need to find the fair value of the asset. So the question said um, we should calculate any impairment loss or gain that should be recognized if the asset fair value less cost to sell at 31st December 2017 is 9,200. So we will take them one by one. So assuming that at 31st December 2017, the fair value less cost to sell is 9,200. So what we do is that the current amount of this asset will be 9,200. Okay, because this is the fair value. So it means that once we classify an asset as held for sale, going forward, we only update the fair value less cost to sell. We always update it with the fair value less cost to sell, and there will be changes. Okay, because initially we realized that initially we recognize it as 9,500. Okay, when we decided to sell it, but right now the fair value is 9,000. So this was the initial amount. Now the fair value is 9,200. So it means it has reduced further. Okay, it has reduced further by how much? 300. Okay, so it means we have to recognize an impairment loss of 300. You see, so we record impairment loss in our what's the name? In our income statement. Okay, so when we record this, then we record impairment loss of this. Okay, so this is for scenario 1. Sorry, scenario I, this one. Now let's look at scenario II, where the fair value less cost to sell is 9,700. Okay, so in that case, the non-current assets held for sale, we put it as 9,700. Okay, as at 31st December 2017. Now we have to compare it to the initial amount, which was 9,500. Okay, so now we can see that there's an increase from 9,500 to 9,700. So this one is called what's the name? This is fair value gain. Okay, this is fair value gain. So it will be 200. Okay, this minus this. So this will go into our income statement. Okay, and then this one will go to our balance sheet. Okay, now let's look at the next scenario. 10,100. So 10,100, it means the non-current assets held for sale, okay, will be in the balance sheet. It will be 10,100, and then the so we'll compare it to the initial amount. So now you can see there's a gain of how much? There's a gain of 600. So this minus this is 600. Okay, so this will be our gain, but there's one limitation. Okay, the limitation is that the initial impairment loss. Okay, the initial impairment loss, and then any subsequent gain. Okay, these are the two issues you have to look at. Okay, the issue is that any subsequent gain, okay, should not exceed the initial impairment loss. Any subsequent gain on the asset held for sale should not exceed the initial impairment loss. Okay, so the initial impairment loss, okay, was how much? When we initially recognized the assets, what was the initial impairment loss? It was
500.
Yeah, it was 500. Yeah, it was 500. Yes. So it means that this gain should be limited to 500. Even though it should be 600, but because the principle says subsequent gain should not exceed the initial impairment loss, we have to limit it to 500, which means this one too has to be reduced to 10,000. Do you get it? So it means that, and that means that the carrying amount, the initial carrying amount was 10,000, right? From the question, the initial carrying amount was 10,000. So what this is saying is that any subsequent gains of the asset held for sale should not exceed the initial carrying amount. Do you get it? Because this was the initial value of the assets when we classified it as held for sale. So it should not go beyond this amount. Okay, if there's any gain, it should be up to the 10,000. Do you get it? So that is why we are restricting this. We are restricting this to 10,000. Where is it? So that's why we are restricting it to 10,000. Yeah. So that is an important principle we have to keep in mind. Okay, now let's look out for measurement of assets no longer held for sale. Okay, now it's possible that we can classify an asset as held for sale. Okay, I think we didn't finish with our question. Let's go back. It says that in each case, calculate the gain or loss that should be recognized on the disposal of the asset. Okay, and that's what we missed. Okay. All right. So the asset was sold in May 2018, and it was sold at 9,400. Okay. So they are telling us to find the profit on the sale, and that's what they are saying. So in our first scenario, where the fair value was 9,700, our profit, profit is just the selling price minus the cost. Okay, so now the selling price is 9,400 and then the cost is 9,000. So here this is going to be a loss of 300 for scenario 1. Okay, we are going to get a loss of 9,700. Let's look at this is scenario 2. Okay, this is scenario 1. So scenario 1, the fair value was 9,200. So the profits or loss is going to be the selling price, which is 9,400 minus 9,200. So here there's a profit of 200, and that's for scenario 1. Scenario 2, there's a loss. Okay, then scenario 3, the fair value was 10,000. So the profit will be 9,400 minus 10,000. The profit or loss. Okay, so this is going to be a loss of 600. Okay. So the loss and the profits, they will be recorded in the income statement as other operating income. Okay, it will go under other operating income in our income statement. So after selling it, the assets will no longer show in our books again, in our balance sheet. Okay, we'll take it off our balance sheet. Okay, let's continue. Okay, we are at measurement of assets no longer held for sale. Okay, let's say we have the asset, we have decided to sell an asset, and for some time, but we didn't get a buyer, so we have decided to, reclassify it back to non-current assets. So in that case, how do we treat it? So we are moving it from held for sale back to current assets. So how do we treat it? Now, remember that assuming that um, we classify the asset as held for sale from maybe 1st January to maybe 1st July. Okay, within this period. So within this period, we were not calculating depreciation because we had classified it as held for sale. So for the 6 months, there was no depreciation. So now, if we say we are sending it back to non-current asset held for sale, then what do we do? It means we have to calculate all the depreciation that we should have calculated. Okay. So it will be assumed that we never even classified it as held for sale. Do you get it? We never even, so the depreciation that we should have calculated, we have to calculate all those depreciation and get the carrying amount if it were not if the assets were not classified as held for sale. Okay, so that's what we need to do. And then we have to compare it to the recoverable amount. So there are two things we have to do. We have to determine the asset as if it was not it was not classified as held for sale, and also determine the recoverable amount. Okay, so let's do an illustration. So we have an asset. We have a truck. Okay, the cost. Maybe the cost is 10,000. Okay, just okay. All right, let's continue. So let's say we have a truck. The cost is 50,000. The useful life is 5 years. Okay, we bought it on maybe 1st January 2022. Okay. All right. So this is the information on this asset. And then on let's say 1st January 2024, we said we are going to sell the assets. Okay. Then on 1st July 2024, we decided not to sell the assets because probably we didn't get a buyer. Okay. So we have this information now at this point. So now our issue is how should we recognize the assets on 1st July 2024 when we decided not to sell the assets. Okay, so let's see how we'll go about this question. Okay, so first we need to determine the carrying amounts on the date that we decided that we are going to sell the assets. Okay, so that will be carrying amounts as at 1st January, because that's the date we said we are going to sell the assets. Okay, and we know carrying amount is equal to the cost minus the accumulated depreciation. So our cost is 50,000. So what is our accumulated depreciation? Okay, we bought the asset on 1st January 2023, and now we are at we are on 1st January 2024. So that's 1 year, right? So this is just 1 year.
So we said 2022.
2022. Okay, okay, okay. Yeah, yeah. 2022. Hey, what's happening? Oh, my this thing is misbehaving. Okay, yeah, 2022. So that's 2 years. So it means we have to determine accumulated depreciation for 2 years. Okay, so depreciation per year is how much? It's 50,000 over 5, right? Because the useful life is 5 years. So 50,000 over 5 will give us how much? 10,000. Right, okay. So, and we are looking at 2 years. So it means to be 20,000. So the carrying amount will be 30,000. Okay. So on the date we decided to sell the asset, this is the carrying amount. Okay, and okay, now we are at 1st July 2024. Okay, and we have not sold the asset, and we have decided to reclassify the asset. So what value should we place on this new asset? So the standard says we should find the lower of the carrying amount and the recoverable amount. Okay, so we are going to calculate the carrying amount as if we did not classify it as held for sale. Okay, so what will be the carrying amount as at 1st July? So 1st July this is 6 months, like 1st January to 31st. From 1st January to 1st July is 6 months. Yeah. So the depreciation will be 5,000, or because annual depreciation is 10,000. Okay, so then half of 10,000 is 5,000. So from 1st January to 1st July, the depreciation will be 5,000. Okay, so it means that our carrying amount, okay, so this will be 50,000. This is the cost. Accumulated depreciation will be 25,000. Okay, initially it was 20,000. So this is up to 1st January, from 1st January 2022 to 2024. And then we have another depreciation from 1st January to 1st July, which is 5,000. Okay, so our carrying amount will be how much? That will be 25,000. Yeah. So the standard say look for this figure and compare it to the recoverable amount. Okay, so in the question they will give you the recoverable amount. The recoverable amount, let's say it is maybe 30,000. Okay, it's 30,000. So it means we have to pick the lower. Okay, we have to pick the 25,000. But assuming that the recoverable amount is 20,000, we would have picked this because it's the lower. Do you get it? So if we classify an asset as held for sale and later on we say we are not going to sell it again, that is what we have to do. All right. Is there any questions so far? Okay, let's look at discontinued operations. Okay, discontinued operation. So now, first of all, we need to understand what is discontinued operation. Okay, so a company, okay, may have several probably branches or several product lines. Okay, so maybe if you take um, farm milk have different product line. Maybe they have ice cream, they have fandango, they have yogurt, they have pan choco, they have farm milk itself. So these are different product lines of farm milk. So if let's say probably pan choco is not performing well, or management decide that, oh, we don't want to continue producing fan choco. Okay, so it means this becomes a discontinued operation. Okay, it's like we are no more going to operate it. All right. So the question is, when you decide to discontinue an operation, how do you treat it in the financial statement? Yeah, so that is what we are going to look at. Okay, so a discontinued operation is a component of an entity that either has been disposed of or is classified as held for sale, and it represents a separate major line item of the business, or it's a separate product line, major product line, or geographical area. Okay, so a company may have operations in maybe different regions or countries. So they can even say, okay, they are no longer going to operate in maybe a particular country. Okay, recently there was a company, there was a delivery company that folded up. I've forgotten their name. They folded up in Ghana. They said doing business in Ghana is expensive. So they said they are no longer going to operate in Ghana. So that's a discontinued operation. Okay. So in that case, how do we report a discontinued operation? So what we have to do is that we need to determine all the income. And so for instance, let's take our fine choco for instance. We have decided to stop operating, but before then probably they were making some sales and incurring some expenses. So let's say in this year they were in operation from 1st January up to 1st July, then they stopped. So we have to account for their operations within this period, all their income, all their expenses, the taxes. We have to account for all of them. Okay, yeah. So an entity shall disclose a single amount in the statement of comprehensive income comprising the total of post-tax profit or loss of discontinued operation. Okay, see, so you have to determine the profit or loss of the discontinued operation. Then II, the post-tax gain or loss on the measurement of the fair value less cost to sell, or on the disposal of the assets or disposal group representing the discontinued operation. Okay, so here this is the normal operations. Okay. Then this one is the sale of the whole operation. Okay, so let's say the company, assume that the company has a branch. Okay, they can sell the whole branch, including the building, all the assets in the building and all that. So that is what this point is talking about. Okay, so this has to do with the sale of the discontinued operation itself, and this one has to do with the income and expenses that were incurred before during the period the company was in operation. Do you get it? So when you are discontinuing operation, you have to account for the income and expenses during the period of operation, and then also if there was any sale of assets or anything like that, you also include it. Okay, so that is how it is. Okay, so now let's look at presentation of non-current assets or disposal group classified as held for sale. So what happens is if you take a financial statement, if you take a financial statement, um, what happens is we don't mix the disposal group assets with the other assets. Okay, other, let's say, other parts of the business that is still in operation. So what we do is we in the balance sheet we separate the discontinued operations from the other um, assets. Okay, so if let's say we have assets here, okay, we will have assets from the continuing operation. So we have assets from continuing operation. So those assets will come here. Then we also have assets from discontinued operation. And those assets will also come down here. So we don't mix them. Okay, we don't mix assets from continued operation with assets from discontinued operation. We have to we separate them. Okay, likewise liabilities. We don't mix liabilities from continued operations with liabilities from discontinued operation. We have to separate them. Okay, it's for presentation purposes. It also gives more information on what is going on. So when somebody picks the report, at least the person knows that okay, some of the company's operations has been discontinued. Oh, hello. Yes, boss. Oh, I was off. Oh, in fact, I didn't notice. Wow, thank you for the reminder. Very long time. Oh, wow. Okay, thank you. All right, all right. Ah, oh, ah, ah. What about this thing, pa? Mm, ah. Hello, hello. Can you hear me?
Hi. Yeah, we can hear you now.
Wow. In fact, I never knew I was talking to the air. And I've been talking for so long, not knowing I am offline. Wow. So where was I before I got lost? Please, where did I get to? Hello.
Um,
Yeah. Was that at discontinued operations?
yes, please.
Okay. So was I
So
here? This
is
side
that no. Maybe you can go back one step.
here.
Wow. No.
Okay. Oh, here.
Yes.
Oh, okay. Wow. Okay. Okay. Oh, I didn't notice at all. Okay.
Mm.
Yeah. Okay. Okay. So we were looking at. Okay. Here we're looking at when we decide not to sell the assets. Okay. So um. So I explained this one right. I mean, these details. Oh, I didn't explain it. Hello. Still kind of way is that? Yeah, hello, Mr. Okay. Yeah, I'm going. Yeah. Yeah, I realize it's the network. So I'm trying to reconnect. I'm reconnecting. Okay, thank you.